All right, welcome. We are at the top of the hour, so we're going to go ahead and get started. Today, we are talking our capital markets update and outlook call for the month of May 2022. Today on our agenda, we're going to be hearing from our Chief Investment Officer, Tom Fox. Tom is going to be talking about the positives that are going on in the markets and the economy. He's going to review the headwinds, and then he's going to give us a short-term and a little bit longer-term outlook on what is going on and what we can expect. So that is our agenda for today. If you are new here, my name is Eric Hagen. I am president. I'm wealth manager with the independent wealth management firm Capital Consulting Group. We're located here in Eden Prairie, Minnesota. Together with Tom, our chief investment officer, we also have financial advisors Dan Oshman and Rana Grant. If you are a guest of Dan or Rana today, special welcome to you. And then we also have John Knutson and Marilyn Westmark in client support. So that is our team. We are independent. We are not owned by a bank, by an insurance company, or by a large financial institution. We are truly independent, working in our clients' best interests. Our goal really is to steward long-term relationships with our clients and work only for our clients. We can help you see your entire financial situation today, as well as every year into the future through our personal wealth planning services. If you'd like to learn more about that after today's call, please head on over to clearfinancialfuture.com. There's a 2-minute video there I encourage you to watch. And then secondly, we can give your life savings the attention it deserves. To learn more about our personalized approach to portfolio management after today's call, you can head on over to smartmixportfolios.com. We have a very full education calendar happening right now. So I also encourage you after today's call to head over to the events page on our website. Next week, we have a presentation titled Life After Work, How to Create a Good Life in Retirement. Then in June, we start to transition into legacy planning. So we have 2 workshops in June, 6 steps to legacy planning for the generations. And then we also have how to plan, communicate, and execute the smooth transfer of assets and values from one generation to the next. Later on in June, very timely subject with everything going on from a technology standpoint, we've got some cybersecurity educational workshops coming up. We've hack-proof your smartphone. So if you have a smartphone, I definitely want to be on that call. And then we have our more comprehensive cybersecurity presentation later on in June called 1 Hour to Savvy Cybersecurity. We cannot be too safe. On that note, protecting ourselves online has become something that's been very important, but we don't want to forget to protect ourselves offline as well. So right now, during the month of May, we are doing complimentary shredding. So you have the opportunity to bring your unwanted, unneeded documents to our office, and we would be happy to properly dispose of them for you. If you're ever wondering what you should keep and what you can toss, we have a very handy Keep It or Toss It guide. You can get that also at our website. I do have the link down there. But if you go to the website and just search Keep It or Toss It guide, you will find that as well. Looking out a little bit further, we do this call every month. I want to update the positives, the headwinds, and then our outlook, keep everybody informed. In June, we will do that again online as we're doing it here today. But then in July, we will be doing it live at Oak Ridge Country Club, and we're going to call it our special halftime report. So we will be halfway through the year, and we look forward to getting back into some in-person events. So mark your calendar, watch the website. Right now, the plan is to start at 11 o'clock with lunch to follow. So keep your eyes on the website for any changes to that agenda. And then looking out later on in the summer, a little bit of fun coming up. We have our client appreciation event. For those of you who are existing clients, we are so excited to get back out and celebrate you and just show you how appreciative we are for the ability to serve. So we do have Alan Alma's dinner cruise planned for Thursday evening, August 25th. Mark your calendar, details to follow. So we sincerely hope to see you on that cruise. All right, with that, I'm going to turn it over to Tom. Tom has over 35 years in the investment business. He has over 26 years as a chief investment officer. He has a very long resume. I won't go through all of this here today. But the one thing I will say is that if you do have any questions for Tom, as Tom is going through his message for us today, please feel free to put them in the chat box, put them in the comment section down below. I'll be monitoring that as Tom is going through his message, and I'll be sure to bring those up. So with that, we will bring Tom on here. Good morning, Tom.
Good morning, Eric. Hello, everybody. Good to see you. So we're going to go through our current view and what we think is coming. I want to just remind everybody that back in December, when we did our 22 outlook, we forecasted that the S&P 500 would go into a correction, and that it has corrections anywhere from minus 10% to minus 19.99%. And we have been right in that range. We're now approaching the higher end of that drop, but we still have not gone into a recession, a bear market. So we've been saying we don't think it's going to happen, but we're bumping along the bottom. But it's amazing. We're going to see a chart how many times the market in every decade got close to a bear market, but it was a large correction, around 18, 19% drop, but then had a huge uptick over the next 12 months. And I'm going to give you some evidence why we think this market is about ready to turn around. I would mention this. We don't think it's a good time to get out of stocks. We would say focus on the next 12 months. So that's what we're going to look at. So here are the current market positives. Inflation is showing signs of peaking with some components starting to come down gradually, but we need bigger drops. We saw it only drop 0.2% from the peak the month before. We need something more significant, and it may come from used cars, from the auto realm, which is a big part of the inflation rate. So another positive is a contrarian indicator, and that is that sentiment, investor sentiment, is now at rock bottom. We're in extreme bearishness in terms of sentiment. That is always a sign that you're coming close to the bottom. Remember, markets don't bottom on good news. They bottom on news, which we have already out there in the markets. So also another one, the number of stocks above the 200-day moving average. And the 200-day is very important for a stock. It looks back at the pricing over 200 days and draws a moving average. And right now we have a lot of stocks, the majority of stocks below their 200-day average. And we're at a level where when this happens, there is a 90%, 89, 90% probability of stocks being higher in 12 months. So that's another contrarian indicator. When you get to this level of bearishness, that's a great time to get into the market. Although, let's face it, at any bottom in the stock market, nobody feels emotionally good to go in. I remember back when we got out of the market during the pandemic beginning in February of 20. And I remember I called Eric and said, Eric, I think it's time to get back in. And he can tell you how he felt, because it never feels good to go back in towards a market bottom. It feels terrible. Your gut's a little wrenched.
Yeah, I remember exactly that conversation, Tom, and I remember exactly what I said. I said, so this is how bad it's supposed to feel when it's time to get back in. You're exactly right.
So we did. We put half the money back in, and it turned out to be a great call, because it was just, I think, the day later or a couple of days later, the market bottom. So we have a lot of experience. I've been around in the markets for a long time. So we have a lot of experience with corrections and bear markets and so on. So another positive is the households. We've talked about this before, in great financial shape. They have a lot of money, ready to drive the service sector. Now we've been talking about a transition from people buying big good items to people buying more services during the summer and so on, like Eric going for a trip, going on a vacation, in other types of services, that sector has been dragging beneath the good service, the good sector, and we think that's a turnaround. So it's kind of a baton handoff to keep the economy up and running. Another point is how inexpensive stocks have become. We're at a point now where stocks are looking attractive after this down market. There's a lot of indications that this is a good time to get in. So here's the wall of worry. And how many know that I'm always worried about the wall of worry? But markets climb walls of worry. And yesterday was a big one. Now, one thing that was missing in the bottom that we had reached, I thought, and I was wrong on this, I was right on the correction part, but I thought end of February, early March was the bottom and that for the year. Turned out it went down another 4 or 5% from that point, still avoiding a bear market. But yesterday we had a big drop in stocks yesterday, and primarily because the inflation costs were hitting in the announcement of Walmart and Target earnings and their outlook. So their companies, what they're saying is, we had higher revenues, but we missed on the earnings, and the cost of goods to fill their shelves and their labor is higher than they expected. So they were surprised. Walmart was surprised. Target was surprised, and the whole market was surprised that they missed earnings by that much. So that's a big drop, and a big wall of worry. And so the inflationary pressures just remain too high. Again, in April, the reading only dropped 0.2%. Another wall of worry is China's COVID surge, supply chain shortages that come from Shanghai, which shut down the whole city. It's like 20 million people. And now it's looking better in Shanghai, and they're starting to reopen. And they followed the normal pattern of days before COVID-19 will peak, was around 30 some days. So Shanghai is starting to look better. They're starting to open up, but now they've got the same issue in Beijing. So this is causing a lot of issues, but there's a positive going to come out of here. But I would say it's Beijing will look better in about 50 days from here, and they'll start reopening. Now, here's the other wall of worry problem, is the Fed is determined to stop inflation. So they've announced, and we're expecting a 0.5% rate hike over the next two meetings. Now, we don't have visibility beyond that, but they just yesterday, Powell made a comment that they're going to do whatever it takes to get inflation under control. Well, that's continuing raising rates. Right now, we know there's 2.5 points coming, and they'll be data driven. So we'll see what happens there. And there's the fear out there is that the Fed, in its attempt to stop inflation, is going to slow growth in the economy and even possibly bring it into a recession. So that's the war going on, stopping inflation, but are you going to stop the economy? And that's a tug of war, and we'll see if they successfully do it. It's been done before, very difficult, but we'll see what's happening over the next few months. Now, Russia-Ukraine, that war continues to rage on. There's no end in sight yet. We're hoping that comes to an end. That would be a big boost for the market. If Russia says that's enough, we're going to pull back. We don't know what their plan is, but that continues to run today. So we can't really forecast that. That's one of those geopolitical events. And usually geopolitical events, you just can't forecast. Now, there's an increasing number of investors that see a recession. You'll be watching cable news, financial news, and there's a lot of people saying recession. And then there's people that saying there is no recession. So we're in the camp that there's not going to be a recession. That's where we are today. And we think that will be good for the stock market over the next 12 months. I wanted to show you this just to show you how difficult the markets have been. As you can see, if you look at the far right column where it says YTD at the top, that means year to date. And this is all the indices that you normally would think about. But you can see the S&P is 1512. As of yesterday close, it was down 17.2. So that's dropped another couple percent. And you can see all the way down the line, the international stocks breaking out between growth and value and so on. What is really surprising and doesn't happen very often, except for in the early 70s, we have the US bond aggregate, which is the benchmark for bonds, is down nearly 10%. It's actually been below 10, but as of last week, May 13th, the end of the week, it was down 9.71. If you're in corporate bonds, you're down 13.37%. And you're nearly down 10% in municipal bonds, 10 years. High yields down 10.4. So you can see there's been nowhere to hide in stocks or bonds. So if you look at the total U.S. market, it's about down it's about 18.89 right now. So there is terrible returns for both stocks and bonds. I was just reading an article that the average 60-40 portfolio as of Friday was down 14%. And the typical 60% stocks, 40% bonds, down 14%. But after yesterday, it's probably down 15.5%. So if you were in a 60-40 portfolio, you're down about 16% year to date. Now, I wanted just to bring up our strategies. We have 8 strategies, and 7 of our 8 strategies are outperforming their benchmark. Wide moat, I just looked at it even after the drop yesterday, and this is before transaction costs or management fee. This performance is done by Morningstar. The wide moat, smart mix wide moat's only down 13.36, which is nowhere near a bear market. Our durable dividend, which is for those who want a little more income, that's only down 12.71. And then we have our tactical style, that's down 11.95. Our tactical sector is down 6.72. And then we have 3 of our strategies that have delivered positive returns. And the one that we used in that, let's say a 60-40, the 40, we call it fixed alt, that's up 1.25%. That's compared to a minus 9.71 for the bond aggregate. And that's way ahead. Obviously, it's about 12% ahead of its benchmark. And then we have a super dividend portfolio, which is dividends around 5+% that some clients will add to the durable dividend. There's a little more risk in it, but you get a higher dividend. That one, year to date, is up 5.97. And then we have something that's called recovery. And this was the stocks that were really beaten up during the pandemic. And that recovery portfolio is up 16.35% year to date. So we have 3 portfolios that have a positive return this year. By looking at that chart, that's very rare. And the only one that we have, remember I said 7 of 8 are outperforming their benchmark. The only one that's not is thematic. Thematic's down about 25%. So that it went into a bear market like large growth. And it is a kind of a tech growth. Tomorrow's revenues. It's the disruptor portfolio that didn't do well last year. The prior year, 20, it was up 60, over 60%. It was down last year around 10 or so, but it's in a bear market this year. We have seen just over the last 5 days that portfolio is starting to gain relative to the S&P 500. We hope that continues. It's extremely undervalued. This has been sort of a thorn out of our 8 strategies, but we're expecting that it will recover at some point. We hope it's this year, and we've seen a couple signs of life in it. But then we have our other core strategies like wide moat and durable dividend that are really doing well, nowhere near a bear market. So you can talk to Eric about that, or your advisor, on which.
Yeah, if you are currently in these strategies and you want to review which ones you're in and what the weighting is in your accounts, be sure to reach out to either myself, Dan, or Rana, depending on who your advisor is, and we'd be more than happy to review those allocations and then look at the performance for your individual accounts. If you're not invested in our Smart Mix portfolios or in these strategies, also definitely reach out to us. We'd love to have the opportunity to show you what that might look like.
So we have 8 strategies to pick from. So, and a lot of them are doing really well this year. All right, so let's look at the rest of this half, May and June, and then we'll look at the second half. There's been really severe bad news. Probably not stated so well, but it's severe. Is mostly in stock prices, but a washout may be here or soon. And I think yesterday we saw that part of that washout, many technical analysts said that's the one thing we're missing to find the bottom, was a washout. And I think we had that washout yesterday, or we came close to it. This may be a bottom. We'll have to see. The market, let's see what it's doing today. I'll give you an update. So
NASDAQ's up 0.5%. Yep.
So what happens? The IVV, or the equity market, is down only 14 basis points today. It was down over 1% earlier. The futures were down. So it's possible that washout that many technical analysts were looking for arrived. Now, could we have one more? It's possible. But we think we're very close to the bottom. So the stock market lows may be still ahead of us, but we don't see much more coming out of it. Our view is that we're going to hold to that 19.99 drop, that will be within that. We're getting close. We're around 18% right now, or 17.9. And hopefully we're going to hold. And I'll show you a chart that does seem to hold in every decade right below the 20. So we'll look at that. So the stock market lows may be ahead, but the Fed may go. How come? The Fed may go too far, maybe driving us into recession. This is not our view. We believe the fast rise in the 10-year Treasury yields have done a lot of the work for the Fed, already discounting where the Fed's going, and they're discounting a lot of rate hikes. What you see in the 10-year is that there's going to be a lot of rate hikes. If you look historically, most of the futures and the forecast of the rate hikes are overstated. And we think it will happen again in this run. So that would be bullish when they don't decide, hey, we're not going to go higher in rates. And the investors are expecting maybe 2 more, 3 more, and it doesn't happen. That's very bullish. So again, it's not our view that we go into recession. First quarter corporate earnings, we're going to see a chart on that. Revenues have come in above analysts' estimates, except for Target and Walmart and a few others. Family households still have an abundance of saving. My final word on where we are right now is be patient. This correction is taking time to work out. and it may take a little longer, but a new bull market and an amazing buying opportunity is getting closer. Again, we don't think it's the time to sell, but to focus on where will stocks be in 12 months from now. We think prices are very attractive. So this is a chart showing how many stocks in the NYSE are below, really above their 200-day moving average, which would be a positive thing. And you can see that it's reached 21.7. That was as before yesterday. So I don't have the up to date, but most likely that's fallen to 20 or below in that washout yesterday from Target and Walmart's earnings announcements. So what does that mean? There's a 89, you could say 90% chance stocks are higher in 12 months. When this occurs, this is a contrarian indicator. And what it means, there's a very high probability we're going to be much higher over the next 12 months. Another positive is the S&P 500 earnings are still expected to grow 9% this year. And that's coming off a gigantic 50% rise last year. You can see that the S&P 500 earnings are still coming above analysts' expectation, and they're 33% above the pre-pandemic levels. So corporate earnings have been doing quite well, and they're still going to be decent this year. Now, this is the actual print. This was just taken a couple days ago. And if you can see the circled boxes at the top, that 76% of the companies that have reported so far, and there's been 458 out of 500, where 92% of the S&Ps reported. We just saw Walmart and Target report the last few days. But 76% of the companies have outperformed the analyst's expectation. And the surprise was 3.7%. That's decent. So then in the right box, you can see 72% beat on the revenue, the top line. And that was by 2.9% of a surprise. So what that tells us now, if you look in the data, the one group that has not done well is consumer discretionary, both in the earnings and also in the revenues. That's been the one sore spot. Otherwise, a lot of the industries are doing well. So we've been talking about valuations, and history suggests that periods of gloom, like we're in right now, may be among the best times to buy equities. And why? Because when you have gloom and you have down markets, the PE ratio, which is a measure of valuation, goes down and makes stocks more attractive. And today, the forward PE is below its 25-year average. And that has even dropped further as of yesterday. So the stock market is not overly expensive, which may mean this could be the best time to buy equities. Now, this is an interesting chart. It shows every decade has had large corrections. And you can see the orange bars, and that's in every decade. And look how close those decade lows have come to a bear market. And then look at the blue, which is how much they go up annualized after. These are outsized gains. Once you get close to that 20%, that's historically been a great time to buy, because you're going to have a lot of upside over the next 6 months. And this is not the 12 month, this is just the 6 months. And then see the last bar, we're at 18.1. What will be the next 12 months? So this chart is really pointing to you. We need to focus on, as investors, on the next 12 months. because we're at a point where this is typically going to be a very good time to enter the stock market. Again, it doesn't feel good, as Eric and I experienced in February of 20, but that's when you want to go in, is when you feel least likely to go in. I mean, if you're feeling really good, that's not the bottom of the market.
Yeah, I like your attitude of looking out 12 months, Tom, but just making note of this chart too. The blue line is 6 months, right? So I definitely agree with you that it's important to look out 12 months, but these numbers get even more impressive when you realize that's a 6-month return after the bottom.
And that would come in line with our initial S&P 500 target.
Yeah.
We originally had 5,300, then we dropped it to 5,100. And I'll show you what my new one is.
Okay.
Another chart. All right. So the current employment is low. Here's another positive. Typically you don't go in a recession when unemployment is low. The tightness in the labor market, there's plenty of jobs out there for people that want to work and can endure offsetting softness in other areas of the economy. As the service sector picks up, this, we believe, will keep us out of a recession. You don't typically have a recession when you have this low of employment. So this is a good sign in our economy, and we think it's one of the reasons that we will not go into recession. Now, here's something good news on the inflation numbers. Auto stocks are typically a leading indicator. So if you look at stocks on autos, they've come down. Now, if you look at the chart, you can see them falling off in the top box. That's relative to the S&P 500, which tells us they're underperforming. And then if you look at the one below, you got the big names, Ford and GM are down. And then there's one AutoNation that's up so there's really only one up out of all those stocks. That typically leads in used car CPI, which is a big number for the CPI, is used cars, autos. So if this is true and follows through, that it's a leading indicator, that may be a sign of things to come, that the auto impact on the inflation is going to be down, which will bring the total number of the CPI down also. And that's what we need in the next monthly prints. Now, here's our outlook. Some of these are the same from last time. I haven't altered my view. Second half, Fed raises rates less than expected, not more, or not even what they're expecting. We expect it to be less. That's the normal historically. The supply chain start to normalize because we're going to have we have monetary boosts coming to China. They are going to they're going to add money into their economy because of the Beijing and the other cities' problems. So China is adding money. They're going to be stimulating because they need to, because they've been hit pretty hard by the loss of Shanghai and now potentially Beijing. So the expectation is they're going to be adding money to a number of parts of their economy. And not only will that fix their supply chain, but it's also going to boost their economy, which is good for the world. Oil prices, inflation, and supply chains, all these problems we believe are going to decrease. In the second half, we see oil dropping below 100. And then we see maybe 3 months in a row of inflation dropping. We hope it's a lot over the next 3 months. Corporate earnings and revenues, again, they're strong right now. They remain above trend. The economy accelerates. Consumers spend big. They've got a lot of money. Midterm election, stock market rally. Every time we've had a midterm, the year of the midterm, the first half is lousy. The markets are about flat, the S&P, but in every case, in the second half of a midterm, the markets rally, and we're expecting the same this time. And there's my S&P 500 target. I'm
Very
not giving
specific.
you a target. I've already gone 53 to 51, but I'll tell you this. I will make a target the end of June, early July, when I have more data. Maybe it's the same, maybe it's lower. But right now, it's too early for me to make a decision on that. We were right on last year, but I can't see the other guy's cards. So I won't be making that prediction. It will be higher. It will be higher. All right. This is something we need to watch for. Maybe you not even aware of it, but COVID-19 cases have crept up quietly. The number of new cases of the BA.2.121, well, that's a little longer than the name Omicron variant, is steadily gaining dominance. And so you can see the number of cases have been rising. And you can see it's been mostly been on the East Coast, but it is growing slowly. And we need to watch for it. But what's happening in hospitalizations? They bumped off the bottom there. They're still within the range of the all-time low. But what's interesting is that deaths or mortality are still going down. That means that this new type of COVID-19 isn't deadly as much as some of the others. Like Delta was very deadly, Omicron somewhat, but it seems to be less deadly. So the good news is less people are dying. They're making it through. We did see a little bump in hospitalizations, which could impact other surgeries, elective surgeries, but not yet. So these are a couple charts that we need to be watching as we're going forward, and we'll display this on a pretty regular basis. So that's all I have. So what am I saying? I'm saying if you have cash or you're thinking about getting in the market or you got out of the market, should really consider getting back in. We may not be at the bottom, but we're very close in our opinion. And you want to buy when you feel the least positive about the markets. When your emotions don't like the markets, that typically is a good time to get in. You know, the old adage that we use is how people will sell low and buy high. This is an opposite strategy to that. Buy low and then sell high.
Yeah, and I'll just add on to that. Make sure if you're contemplating doing that, that you're doing that in conversation with your financial advisor. We want to make sure that we're looking at the overall picture. We're not, putting money in that you need in a short period of time back. So this is not a trading decision. This is an investment decision. So make sure you're having that conversation with Dan, Rana, myself, or if you're a visitor today, with your financial advisor.
Well said, Eric.
I'm looking at the comments section here, Tom. As always, you did a great job. Appreciate all of the charts and the facts, kind of cutting through all the emotion that is out there right now. It can feel like a scary time to some. So appreciate you. I don't have any questions for you here today. So going once, going twice. If you do have a question, put it in the comment section. Love to address it. If you're watching this in the recording, please feel free to comment on this video on either Facebook or on YouTube. I do watch them. We'd love to circle back with you. Or feel free to email me. It's eric@investwithccg.com. That's Eric with a C. And then, as always, you can find us online at www.investwithccg.com. A couple other quick reminders. Every week, every Monday morning, I do a short kind of update on what is actually happening in the markets. I do it just like we're doing here today, live on Facebook and YouTube. And then I put the recording on our website, and I email a link to it later. So if you'd like to get that email on Mondays, I just send out one email a week, 3 o'clock on Mondays, and go to the website, subscribe there. And you can go back and watch previous updates if that's of any value to you. And then just one more friendly reminder. Sounds like we might have an end-of-year S&P 500 call ready for lunch on July 13th at Oak Ridge Country Club. So save the date. We will have a formal RSVP form on the website here soon, so you can sign up. But feel free to let us know if you're able to make it. We'll start building that list out. So with that, I think I will go ahead and wrap us up. So again, Tom, thank you so much. Appreciate you.
You're
Appreciate
welcome.
your wisdom here today, and your balanced approach to delivering us a report on what's going on. So thank you.
Thank you.
All right, that concludes today's capital markets update and outlook call for May. I hope you guys all have a wonderful rest of your day.